Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Michael Reynolds, Vice President of Investment Strategy over at Glenmede. Michael, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Happy to be here.
Let's talk about the CPI reaction. It was such an interesting trade when we saw the futures sell off with the print, only to see it round trip, a move that we've not seen in nearly a decade. Does it suggest that perhaps peak inflation is in, or investors are starting to come to terms with the headwinds that the economy is facing?
Yeah, so we think anyone that took a deep dive into what we saw in that inflation report saw sticky inflation all over it. Shelter inflation, medical services tend to be the components of inflation that have the most inertia to them, that when they pick up steam, that they tend to keep going by sort of their own velocity. We see no signs that inflation is sort of peaking just yet. There were a number of cross currents that I think contributed to yesterday's market action. Part of it is that markets were perhaps just a bit oversold, actually. At Glenmede, we use a proprietary sentiment index that was able to identify first percentile oversold conditions in markets. So perhaps what we were seeing yesterday was a bit of a relief rally from some of the oversold technicals and survey-based data that we get on sentiment.
Third quarter earnings outlook, what's your thoughts there? Have the headwinds largely been priced in, do you think?
To a certain extent in the near term, we haven't seen a lot of earnings impact so far. We're expecting tepid growth for Q3 on a year-over-year basis for the S&P, maybe low single digits. That could come a bit higher if we see companies start to come across the tape with a couple beats here, some significant beats. Some of the standouts are probably going to be the energy and industrial sector, some of the bigger contributors to positive growth. On the other side, financials and communication services, some of the factors that may be leading things a little bit lower. So there's a bit of a tug and pull on these numbers here, but overall it's looking low single digits on our end.
Does the current environment make forecasting a challenge for management teams and analysts?
We'd argue that any environment is a tough one for forecasting. If it were easy, everyone would do it pretty well. But this environment in particular is very tough when you face twin issues here. You face a very historically tight labor market. We don't see labor force participation picking up materially from here due to demographic headwinds. So that can be something that makes it more difficult once more to hire and continue to find qualified workers to get those projects up and running. And the inflation side is obviously the elephant in the room. Considerable uncertainty there. There's been a lot of people calling for peak inflation for many months in a row now just to see it not come through. So there is a lot of uncertainty in this period, and it's going to be very difficult forecasting in the near term. So any forecasts are going to have to be very data dependent on the recent trends.
How's the strong dollar impacting international stocks and corporate revenues, particularly for the real large global conglomerates?
Yeah, sure. So a stronger dollar for U.S. investors, all else equal, means lower total returns on when you look through on the currency basis there. Even for companies that are, or I should say investors that are invested in domestic companies, a lot of companies in the US, especially the larger cap companies, are these conglomerates with a global footprint. There are sectors that are relatively insulated from that with a more domestic focus, such as utilities and real estate, which may be a little bit more, again, insulated from some of these currency movements as they derive a larger portion of their revenues from domestic-oriented operations.
And finally, Michael, expectations for growth in 2023?
It's shaping up to be a tough year. We're expecting recession over the next 12 months. The timing of that is, it's a little difficult to pinpoint in particular, but we have a band around 0% for 2023, given all of this uncertainty. We could start to see by the back half of 2023 that inflation gets under control, that the Fed maybe can take their foot off the brake on monetary policy, and we could start to see growth pick up a little bit then. But that's probably something a little bit further into the future. They're probably the back half of 2023, but low, less than 1% GDP growth is probably the base case, but there's upside and downside from there based on, again, how inflation really plays out here.
Yes, I mean, so overall, it sounds as if investors are just going to have to exercise some form of patience after going through, over a decade where there was, instant gratification with some of those investments. But just because you raise rates doesn't mean that the strategy resets everything and the calculus resets. It's going to take time for all of this to, play through the economy.
Yeah, the raising rates and the effect that has through the economy is going to be a process. It's not going to be an event, and it's going to continue to unfold over the next year or so. And volatility, we expect to stay pretty high here as investors sort of come to term with all those implications. So we think investors are going to have to stay pretty tactical here and try to take advantage of the volatility and finding opportunities perhaps to add value on the margin.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.